Today's guest is Jack Grimwood. Jack is a wealth management consultant and he's unbelievable when it comes to financial and investment and saving advice. In this episode, we're going to be going through the different ways that you can save and earn wealth. Having income and having cash coming in is amazing, but building wealth for long term is amazing as well, because it's going to make sure that you're set for the future. So in this episode, we're going to go through all the different ways in regards to savings and investing that can help you level up your bank account. So I hope you enjoyed this episode. Please subscribe on YouTube, please follow on Spotify, and let's get straight into it. So, mate, welcome.
Thank you,
thank you for coming on, mate.
It's an absolute pleasure.
I appreciate you taking time out of the schedule. I can imagine it's busy. So just before we get started and get into it, I would like it if you could just introduce yourself to the listener who may not be 100% sure on what it is you offer, what it is you do, etc.
Cool. So my name is obviously Jack Grimwood. I am a wealth management consultant. So what I do is I work predominantly with a lot of guys like yourself, so young business owners, young entrepreneurs. I do have some high net worth individuals. I have some sportsmen. It's a mixed bag, professionals. My job really is to sit with an individual and really get an understanding of sort of where they are now financially with the business, with their goals, with their objectives. And I'll sit with them over a series of meetings, really get to know the situation, get an understanding of what they've got, what they don't have, listen to their goals and plans, and then put those recommendations and guidance in for them. So it's a really simple case is look at where they are now, look at where they want to be, help them close that gap in the most efficient way possible.
And that's related to finance?
Yeah, it's all related to finance. So it's, let's say that a business owner comes to me, they've just started out, they've really started to generate some income, but they don't really know how to manage it. This is something that I see, that I learned very quickly actually in the UK, is people are very good at making money, they're not very good at managing it. And when I mean manage, I don't mean budgeting and putting a spending plan. I mean how to facilitate it tax efficiently, how to invest it, how to grow it, how to pass it on, all these different things. So that's what I'm talking about when it comes to managing. So people are very good at making money. They're not necessarily good at managing it, just through lack of knowledge and things like that. So that's where I'll come in and sit with them and say, right, these are your problems, these are your solutions. And then together we'll work on an ongoing basis to help them build wealth effectively. So as a wealth management consultant, it's my job to help them manage their wealth, grow their wealth, pass it on intergenerationally, all these things, because there's a huge lack of knowledge in the UK. So that's where I come in. Yeah,
so I can imagine, like myself being self-employed, and I can imagine a lot of people who are probably self-employed and earning a little bit more and just getting straight into a business that they was passionate about when they was younger. Like you said, it's the trying to change the mindset of being rich from having a lot of income coming in to being wealthy, where you're actually using that income to then facilitate for the future.
Yeah, because what happens is, I said this to you before when we've had previous meetings, is like, what you find is people get a business idea, they throw themselves into it, they're super passionate, they're super motivated, they're super driven, and they make it work. And before they know it, they're earning a lot of money, more money than they thought they would. And then that's where they sort of hit that ceiling, because they then don't know what to do with it. And it can be too easy to just start earning money and just going spending it all and being frivolous with it. And then you get into that trap of the more you earn, the more you spend, and you're never actually making any progress. So that's where I will come in and sit down and say, right, what's actually important to you? You know, what do you want to achieve? Where's the business going? What are your goals? You know, what are you trying to build for yourself? And then we can lay some planning in place, and we can utilize what's on offer with like tax allowances and investment strategies and things like that. And that's where I add the real value.
Yeah. So what's the first step you'd take with someone when it comes to them knowing what to do with the finances in a way that, like you just mentioned, they first need to figure out what it is they actually want? Because like you said, if somebody's spending money on, let's say, the car or the clothes or the food on the weekend, if they then start to earn more money through the business that they've set up, and then they just start spending more money on the things that they're currently spending on, surely that's just going to end up with nothing, because the clothes that they buy are going to get more expensive, the car that they're paying is going to get more expensive. How do they then switch that mindset to being like, right, what do I actually want to do with my money?
That's a good question. So what I'll normally do with someone is I'll sit down and I'll assess the situation first, right? So what you're earning, what are you spending, why are you spending it, things like that. So behavioural finance stuff. From there, we can then go, okay, this is your income, this is your budget, these are all your bills. Do we need to cut down on things? Right. Okay, this is the excess that you've got. This is the difference between what you're earning and what you're spending. Okay, now we can allocate that into building wealth and investing in things. And often what happens is there's a bit of an element of coaching sometimes with especially younger clients that are just starting a business. You know, if you would get like a high net worth individual, the behavioral finance is already there, the income's already there, they understand building wealth principles and things like that, but what they need more in-depth strategy and advice and recommendation. For someone that's just starting, it can be very easy to start just spending your money on stuff that you don't actually need or want. You just sort of, you've got a bit of money, you want to spend it, you want to buy some clothes and buy a car and impress people you don't even like and all that, and it's easy to fall into that trap. So I'll just make a client take a step back and say, right, this is everything that's coming in, this is what's going out, we can cut down on all that, and let's just start putting some basic moves in place, because building wealth's not sexy, it's boring, and it takes time, okay? But the first thing you need to do is just the basic first principles, and that's spending less than you earn, making sure that you've got an emergency fund. You should always have an emergency fund, 3 to 6 months worth of expenses sacked away in a bank account, in a savings account, and that gives you the peace of mind, and I call that your sleep at night money. So if anything goes wrong with a business, or if anything goes wrong at home, like the boiler breaks, car breaks down, you've always got that cash buffer, right? So if a client comes to me and they just spend, and they don't even have that, I'm not even going to take them on as a client. I'm going to say, right, you need to go away and fix this. You need to cut down your spending. You need to assess your budget. You need to build this reserve at least 3 months, because I won't take a client on unless they've got at least 3 months of emergencies in place, because then the planning I put in place, they don't ever have to interrupt.
Yeah.
Because if we start to say, right, we're going to commit X amount into investments and pensions and things like that, if an emergency presents itself to them, right, the worst thing you can do when you're investing and building wealth is A, interrupt it, or B, which is even worse, tap into it, right? So we need that emergency fund straight away. Once you've got all that and you've got control of your spending and you've got your emergency fund in place, that's when we can then say, right, what are we allocating to where and how are we going to use it? And then I will start to, over a series of meetings, educate them on investing, on different tax wrappers and things available to them. I don't want to sort of go in too much jargon on this, but educating someone to say, right, you can use this and this will benefit you, you can use that and that's going to help you, etc. But the starting point is just getting a grip of spending. You know what I mean? We've talked about this before, haven't we? Like,
I was just going to say, one of the things that I think you've read the book, The Psychology of Money, Morgan Housel.
Great book.
And the quote where he says, spending money to impress others is the fastest way to lose money.
100%.
Yeah.
Going broke, trying to look rich.
Yeah.
Right? It's a huge problem we have in the UK. Not for the older clients, but for the younger clients, because of Instagram and all that. Like everyone's just obsessed with trying to show off and trying to look good, you know. And I'm obsessed with like stealth wealth, and my saying is low key is the key, right? If you can just slip under the radar and not fall into the trap of having designer brands and all the flashy cars and all that. I had a young client the other day who's doing really well for himself, and we were talking about his car. He's got like an older car, and the finance comes to an end. And I said to him, look, just keep that car. Don't go out and get something nice. You could afford something really nice. And he's like, no, I'm not going to. And I said to him, would you rather, drive around in that car knowing it's paid off, knowing that you're building assets and you're investing and you're building wealth, or do you want to go out and buy a fancy car and have nothing? Do you know what I mean?
Yeah, 100%.
It is a problem. So I think this, one thing I just want to say on this podcast before we actually get further into it is I think it's really good that we're doing it, because you're adding value in the sense that on this podcast we're only going to give guidance and a bit of insight. But there's too many people now on Instagram and TikTok with a mic that think they're an expert in any field. That's not just finance, that's fitness, finance, business, all that sort of stuff. And there's so much misinformation out there that it's almost impossible to decide what's right and what's wrong. One of the things I do is I give very bespoke, tailored advice to the individual, because not one piece of financial advice fits all. And too many people can just go on TikTok, see someone ravel something off that they've seen on Google and go, take it for gospel.
Yeah.
You know what I mean? I think that's quite dangerous to the world that we live in.
No, 100%.
And I think part of that is a big problem, and part of it is people are trying to show off and try and flex and almost compensate for the money that they don't have.
Yeah.
You know what I mean? So it's good that you're doing this, because you can give some insight and some guidance to people.
Yeah, it's a long form content as well, like you said, because people's attention span is just literally whittled down to the same as a fish, and they can't even go without watching 9 seconds on a TikTok without getting bored and swiping on to the next one. Like you said, the people then, don't get me wrong, they're probably doing it from a good business perspective where they're capitalising and making sure that it's quick information that people probably sign up straight away and pay. But like you said, the person who's probably built wealth and mass amounts of finance over the years is probably the person who's not doing that. They're not flashing
listen,
the Lamborghini
the wealthiest people, my wealthiest clients, you'd never even know they're wealthy. They completely slip under the radar. And again, going back to the whole internet thing, the people that are selling courses on how to do this and that, they're making money by selling courses. They're not making money by actioning what they say. Like, you will never see an authorised and regulated person like myself pushing a course or trying to sell a course. That's not how I make a living. Do you know what I mean? So people have just got to be really careful.
So the Forex trader that told me I'd get 3 million in a week,
mate,
it's not going to work.
No, I'll get your money back.
I'll cancel that subscription then, mate, unfortunately. I'm gutted.
That.
So something you did touch on then, though, was people spending the finance and the wealth or the income that they're getting that's quick on assets. So for the person that's listening who may not be 100% clued up, what would be the difference between an asset and a liability?
Yeah, so again, there's a lot of jargon in finance, and I'm the translator of jargon for a lot of my clients, just to help people navigate. So we'll keep it dead simple. So all an asset is an asset is an item or a financial instrument that's you purchase with the intention that it's going to go up in value through a capital gain, or it's going to provide an income. Okay, so there's all kinds of assets out there. There's property, there's stocks and shares, there's bonds, there's gold. We can argue that watches, we're both watch enthusiasts, could be an asset, things like that. An asset can be a store of value. So it can be something that you put money into and it at least just keeps up with inflation, so you can get out of it at a later date and it's sort of held its value. So that's all an asset is, basically. There's some confusion sometimes where you hear some people online say, like, your main residence is not an asset. Because it costs you money and you've got to maintain it and things like that. I would argue that your main residence is an asset for the sole purpose that your house that you live in, yes, you're paying a debt on it and yes, you're paying to maintain it, but over time it's going up in value. And a crucial element of that is, as it stands, that value that grows is tax-free if you sold it, as it stands. Legislation changes all the time, but as it stands, that is. So I would argue your main residence is an asset. Yeah. So an asset is basically anything that you can purchase and put your money into. It's going to go up in value or potentially provide an income. Yeah. Okay. A liability, on the other hand, is just the opposite. Yeah. It's so simple. It's something that's going to cost you money. It's going to extract your resources. It's going to go down in value. So again, something like your car. People sometimes say, "Oh, a car's an asset because I can sell it and make money." Well, it's not. It's a liability because you've got to maintain it, you've got to insure it, fuel it, and also it decreases in value over time.
And there's a whole saying of a car goes down in value as soon as you drive it out the showroom.
Yeah, absolutely. So again, going back to people that you see predominantly young guys flying around in brand new BMs and Mercs, but live in their mum's back bedroom, they're flying around in a liability because it's going down over time. So in an ideal world, what you want to be doing over time is accumulating more assets and decreasing your exposure to liabilities. And that's the fastest way you're going to build wealth.
And touching on that, would a person have to really sit and think with themselves, what is it that they want to get out of their life? Because obviously you've got the people who think, but I want to spend my money now whilst I'm young and enjoy it. Is that a conversation you've got to have with themselves?
Yeah, that's a problem I have. Again, we're just slaying young clients here, aren't we, big time? Because the older clients get it. They've kind of had that period of, I'm going to just spend my money, enjoy myself. And then they sort of
only live once.
Yeah, but then they're taking it a bit more serious because they're going, okay, I'm in my 30s, 40s. I need to really start thinking about, the long term here. Whereas when you're young, it's too easy to go, I'm only 25, I've got decades. I push on clients, you've got to think in decades and not days, right? So it's too easy to go, I'm only 25, I'll go buy this, I'll go buy that, I'll go do that. I can't tell you how many younger clients have sat with me and gone, I don't need a pension, it's too far away, right? Building wealth, time is your best friend, right? The reason why those older clients are flapping is because they're going, I've only got 20 years. Whereas if you're 20, 21, 22, 23, and you're starting working for yourself, you've got 4 decades potentially. You know, I work with people a lot that have been paying into investments for literally decades and they're still not where they need to be. Not where they want to be, where they need to be. Okay, we have a big problem in the UK with what's called the savings gap. And that's the difference between what people are putting away and what people actually need to sustain themselves and live the lifestyles that they want to live when they're older. So when I'm sat with a younger client, it's about behavioural finance. It's about flicking that switch and saying, look, all that stuff doesn't actually matter. You know what I mean? The nice car, the clothes, no one actually cares, to be honest, anyway. So start making the right moves and building wealth, because you're 21 now. When you're 31, you can either get to 31 and not have anything, or you can get to 31 and have assets and investments and money working for you and go, oh, I'm really grateful that I did that. So yeah, it's an ongoing battle, mate, with younger clients. Because another thing that I always find, and people might relate to this, is I'll put a plan in place, and you might get this in the fitness side of things, right?
I was just going to say that.
I will sit with a client, we'll do all the planning, we'll do the cash flow modelling, I'll make all the recommendations, I'll do everything, because I can get you to where you want to be, right? If you come to me with the right mentality and discipline, with the resources, obviously, I can get you to where you want to be. You've just got to stick to the plan. And I'll do all the planning, and 6 months in, client rings me up and goes, oh, I've decided I'm doing this now. Oh, I want to do that now. Oh, actually, I'm going to buy this car. I want to do that. Or worse yet, I've seen this thing on TikTok. Or this person in the pub told me I could do this. And I'm like, they're not authorised, regulated. They're not professional. They don't do this every day, right? Yeah. We've put this plan in tailored to you, so let's stick to it. And I think the issue for the younger client is, and for some of the older clients, is it's too far down the line.
Yeah.
So it's very hard to commit to. Everyone wants results today. You'll see that in your fitness world. Like 100%. People want to be shredded last week.
They want the 6-week six-pack.
Yeah, 100%. We both know that doesn't exist. And people want that with the financial planning and building wealth. They want to be rich. They don't want to be wealthy.
It's kind of taking the sacrifice now for X, Y, and Z. The more expensive car, if you could just budget on that a little bit and maybe have the car that's not as expensive but still ticks most of the boxes that you want. It's just not got the spoiler on that you want, or the blacked out alloys.
And I don't think there's anything wrong with having nice things in your life. Like, we all like nice shit. You know what I mean? Like, we all aspire to work towards something materialistic, and it pushes us into business and it does things. And I think obviously as your life's dynamic and it changes, and as you have kids and stuff, you know, your goal is then to provide for your kids and all these other things. So I don't think there's necessarily anything wrong with having a materialistic goal, but tick a load of boxes off first before you indulge in that. Because another big thing about the financial planning I do is I say, right, let's commit X amount to this goal that we've discussed. You know, I have this young client, she's great. Her goal is to be a millionaire grandma. Right, that's her thing. She's like, I want to be a millionaire grandma. So, you know, I said to her, right, let's commit X amount into your investments and into building your wealth, and then you can go and spend whatever's left and indulge without the guilt of doing so. Because you know, well, I'm on track. If I do this, I'm on track to get to millionaire grandma status. Okay? And so if I put this amount every month from the business, I'm saving tax, I'm building wealth, I'm doing this, the rest is mine. I can go on holiday, I can do this, I can do that. And that's the difference. You need to switch. Most people will spend everything they've got and then try and save what's left. I always say pay yourself first.
Yeah.
So your money comes in, you skim off the top. That is committed to your future self. You pay yourself first. Then you pay your bills and all the stuff that if you didn't pay, you get in trouble. Then what's left, you spend.
I think that's on the shit that Robert Kiyosaki.
There's loads
Rich
of guys.
Yeah.
I mean, I'm going to take full responsibility for it,
I'll take that, mate.
Yeah, but
he talks about the pay yourself first. And obviously, we're talking about saving.
Yeah.
And
it's the same with saving and investing, mate.
Yeah.
Yeah.
Because like I said, if you're saving that money monthly or weekly or whatever it might be, that's you're saving for yourself in the future. It's just having that mentality that it's still going to be your money. You're not wasting it.
And off the back of that, you know, I don't need a pension because I'm too young thing. Statistically speaking, you're going to get to 60 years old. Like, you are, right? And with the way medical science is going, that statistic's only becoming more positive. Like, you are going to get to 60 years old. So I say, do you want to get to 60 years old and have a huge pot of money? to have a really nice, comfortable lifestyle. And speaking of medical science, you could potentially live to 100 years old. So that's 40 years if you want to retire at 60 that you have to sustain yourself financially, right? So statistically speaking, you're going to get to 60 years old. So do you want to get there and have a massive pot of money knowing that you've made all the right moves and that you've been disciplined and you've gone without a few things to build that wealth? Or do you want to get to 60 and go, I don't have a pot to piss in and I'm going to have to rely on family members to look after me and be a bit of a financial burden and things like that? When you think of it like that, you go, actually, yeah, I should probably start making some moves.
What about the person who's thinking, I don't want my money when I'm 60 and I want my money a little bit earlier? Are there still ways they can invest?
Absolutely, yeah. So I've got this with literally had a meeting this week. Young couple doing really well, turning over like over £1 million a year in their business, and she's adamant she wants to retire at 40. Fair play, right? They're working hard, they're building a business. A lot of people hear the term investments and they think it's tied up, it's locked away, I can never access it, sort of thing. It's not the case at all. What I do with clients is I layer up different investment, what I call tax wrappers. So they're basically things that you can use in the UK to invest your money tax efficiently, right? So what we'll do is we'll put planning in place where you'll layer up your assets and your investments for accessibility. Without going into too much context, a standard thing like that would be cash. Then we could just use a stocks and shares ISA. Really good tool for building wealth. You can put 20 grand a year into it. You can invest globally into stocks and shares. It grows completely free of income tax and capital gains tax, and it's accessible whenever you want it. So it gives you that liquidity, that accessibility
Of being able to pull it out earlier.
that you can need. So, for example, for this client, we're going to build up some cash reserves. Then we're going to build up ISAs over, decades, where she can have a really big investment pot that's completely tax-free and accessible. So if she retires at 40, you can't access at the moment, again, legislation changes, but you can't access your pension at the moment in the UK until you're 57. That's the early retirement age. So we need to finance her lifestyle between 40 and 57. You just do that through cash and ISAs. So you'd have cash, ISAs, maybe some other investments, and then pension at the end.
Yeah.
So you've got that layered. You've got a layer of investments to finance the lifestyle that you want in the future.
Yeah, amazing. So for somebody who's first looking out to invest, what would be, I know we've spoken about at the start, having that emergency fund saved up first, which was around about 3 to 6 months of like your income that you're earning at the minute.
Yeah.
What would be the first thing that they'd then look to invest in potentially asset-wise?
Okay, so great question. I'm just going to do, because again, this might resonate with people, so I'm just going to do what I see the first investor do. This is what they normally do, right? So, bad reputation of investing in the UK because a lot of people think it's a scam, think it doesn't work, etc., etc. The reason why the wealth gap is growing, okay, so the difference between the wealthy and the poor is growing, is because the wealthy understand that you have to invest money. Anything over and above an emergency fund needs to be invested, okay? But what the problem that you see in the UK is people go, I'm going to give this investing thing a go. And the first thing they'll do is they'll chat to people in the pub and get an idea of what they think is a good investment. They'll open up a trading 212 account, yeah? And the first mistake they make is they invest in individual stocks. That's a bad idea, okay? Because you need to do a lot of research and looking into the fundamentals of that company and the earnings reports and the pricing ratios and all. It's too complex.
You're putting all your eggs in one basket.
All your eggs in, you're not diversified. And then what happens is they go, I think that this particular company is going to do well, so I'm going to put all my money into it that I've got. The next day they log into the app, market's gone down for whatever reason, and they go, oh my God, the value's gone down. They panic, they get emotional, they go, I'm going to sell it. They've made a loss, and they go, yeah, investing's a scam. Never do it again, right? Part of what I do for my clients is take away that emotional response. So when the markets do go down, I'll say, look, the markets are going down because of this. These are the reasons. This is what's happening. But let's take a step back. Let's zoom out and let's look at markets and what they've actually done, okay? We're thinking in decades. We're not thinking about today, right? And stop clients from making those decisions. I probably add a lot of value just from stopping clients from acting on emotion. Yeah. Going back to the scenario about what they should invest in is they should invest in normally an index or at least a portfolio. So a portfolio is a collection of assets. And that can be stocks and shares, it can be property, it can be bonds, it can be whatever. So you diversified then, so you've spread your risk. Yeah, risk management is really important. Rather than just putting all your eggs in one share, one stock, have it in multiple different stocks and shares, multiple different assets spread around the world. That's your first thing. And that can just be done through an ISA.
Yeah.
Right? So, and the reason you do it through an ISA is any growth is completely tax-free.
Tax-free.
Yeah.
So the person who's earning, I don't want to put numbers on it, but they're earning the income from the business that they've set up, or it could just be somebody who's working the 9 to 5 and getting paid from their corporate company.
Yeah.
That money, they are then saving a small percent to build up that emergency fund. As soon as they've ticked that box, it's saying like, right, what amount of money can I live with and enjoy my life with and indulge with?
Yeah.
The rest of that is going into these assets and the ones that you've just explained.
Absolutely. I'd flip it. I'd go, what can I live my life with and then invest? I'd go, right, I want to invest, 10% of my monthly income, for example. Okay, I'm going to set up a stocks and shares ISA so it's tax free, and I'm just going to invest in a global. You could just do a global index. So an index is effectively a tracker of like the global markets or the global top companies. So let's say the S&P 500, for example, is one of the biggest markets in the world. That is the 500 largest companies in America. Okay, so you can set up an ISA that invests into that. So you're investing in 500 different companies. Yeah. So as those companies are growing, you've got exposure to all of them. So rather than going, I'm just going to invest in Apple because I like America and I've got an iPhone, you're going to be spread across 500 different positions, right? You may be thinking, or people watching this may be going, well, can I lose my money? I get asked that all the time. Can I lose all my money in the market? And that's because they've either had an experience of putting money in one particular share, or they've heard of someone who's lost money in the market. A loss is only a loss if it's what we call realised. So you buy a share at £10, it drops to £5. You've only lost that money if you sell that share at £5, right? If you just hold on to that share and it just goes back up in value and then goes above £10, you've made money. But again, you've only made money if you sell that share. So losses and gains are just on paper. Because I say to clients, if the value of your house went down, would you sell it? No, you wouldn't. You just sit in it and live in it and just wait for it to go back up in value.
Yeah.
So it's the same with a share. So if you have, when people say to me, can I lose all my money? If you were invested in the S&P 500 in an index tracker, you'd have to have 500 of the largest companies in America, trillions of dollars worth of value. They'd all have to go bankrupt and bust overnight for you to lose all your money. Yeah. The likelihood of that is almost impossible. If that happened, I'd be more worried about what I'm going to eat tomorrow than the value of my shares.
Yeah.
Do you know what I mean? So as long as you're diversified and you're in different parts of the regions of the world invested in different asset classes, this is why we build a portfolio of different things to protect yourself against these fluctuations and ups and downs.
Yeah.
Yeah.
But what about the person who thinks, well, Jack, why won't I just leave all my money in my bank account?
Yeah, great question. So there's different risks with financial planning. There's all different risks. Okay, that risk that you've just mentioned there is what we call inflation risk. So what happens is a lot of people do this where they just save, and they think that's the right thing to do. So remember back to what I said then about 3 to 6 months worth of emergency funds. Anything over and above that needs to be put to work, right? And the reason for that is you can stockpile cash in your bank and you feel good, you feel safe. I've got loads of money, I've got liquidity, I've got capital, I can sustain myself. The problem with that is the interest rate that you get on that, not historically speaking, I know that we're seeing relatively okay interest rates at the moment. They're already coming down. The Bank of England's just recently reduced rates, which means banks are going to come down. But historically speaking, the interest you earn on your cash in the bank has never outpaced inflation. So inflation is effectively the cost of living going up. There's more technical analysis on what inflation is, but just for viewers, just to keep it simple, is inflation is effectively the prices of things going up over time.
The price of a Freddo 10 years ago to the price of the Freddo now.
Absolutely. That is the easiest way to do it. When I was a kid, you could get a Freddo for 10p.
Now it's probably £1.50.
Yeah. I feel sick when I see the price for Freddo. But what happens is the money in the bank okay, stays where it is. Everything outside the bank creeps up in price slowly. So what happens is you're sat at night really comfortable thinking that you've got loads of money and you're okay, but actually what's happening is the purchasing value of that money is just diminishing over time. Okay, just like what we've said, if you'd have put 100 grand in the bank 10 years ago, you know, if we look at the prices of Freddos, you know, you're not getting anywhere near amount of Freddos today as you were 10 years ago, to keep it super simple. So that's why, to answer that question, is you've got to get over that mindset of, well, I'm safe, I've got loads of cash, and you have to take risk. Going back to what I said about the wealthy getting wealthier, they understand that they know they need to invest their money. They don't hold any cash. All my wealthiest clients have very, very small amounts of cash on deposit. They literally have enough to sustain 3 to 6 months if anything happened. Everything else is put into investment.
So, in essence, the money that you're saving in your bank, the interest that's earning back is going to get cancelled out by inflation.
Yeah, it's not just going to get cancelled out.
It's going to go down.
It's going to be negative.
Yeah.
The problem with is this silent killer, inflation, because when you get your bank statement every month, your balance doesn't change. But I guarantee if say, for example, the FCA forced banks to incorporate the impact inflation it currently is having on their bank balance,
money that's in the bank,
they would start acting differently.
Yeah.
But because they just get a bank statement that says, I've still got 20 grand, or I've got slightly more than 20 grand because I've got a tiny bit of interest, that's fantastic. It doesn't factor in the fact that the fuel's gone up at the fuel station, the food shop's gone up, the gas and electric's gone up, all these things, right? So what you want to do is you want to put that money to work. The goal is to outpace inflation when you're investing money. You want your money to be worth more tomorrow than it is today. Now, it doesn't happen that quick. It happens over time. But the goal really is to have your money outpacing inflation, and money in the bank is absolutely not doing that.
And surely the banks would benefit from people keeping the money in the bank.
Yeah, of course. Yeah, absolutely. So if you want to get technical with inflation effectively is too much money in the system. Right? So there's too much money sloshing around in the system. There's too much liquidity. So the cost of things goes up, because if there's too much money, a scarcity does things to prices. So when there's not a lot of money in the system, prices come down, okay, because there's a scarcity for that money. People are competing for that money in the system. When there's a lot of money in the system, there's too much money sloshing around, so prices go up. So what happens is, the Bank of England, we're getting technical here, but I'll answer it because I know you like all this sort of stuff. The Bank of England goes, right, inflation's getting high, we're going to increase interest rates. So that then means that it costs more to borrow money. So people are less likely to go buy a house, go finance a car, do all these things. But it also pushes up the interest rates in the bank. So it makes it more attractive to save. So then what people do is they go, I'm not going to go finance a car because it's going to cost me a fortune. But if I save all my money, I can get 5% in the bank risk-free. So people start to save money and hold money, and it pulls money out of the system. Pulls money out of currency and liquidity out of the system. And it starts to, and interest and inflation starts to drop off. That's a bit of a lesson in economics there for you, but that's what happens. So at the moment, what's happened, we've been in this high inflation period because of the war in Ukraine and all these other things that have happened over the last few years, and inflation is starting to come under control, and that's why we've seen just last week the Bank of England has decreased interest rates, because what you do is when inflation's high, interest rates go up. When inflation comes down, interest rates go down.
What effect does that have on mortgage rates?
So it's great news for people that have got a mortgage, especially people on a tracker. So a mortgage tracker it just follows the Bank of England base rate plus a couple of percentage points. So if you're on a tracker, you're just tracking that Bank of England rate. So when it comes down, your rate comes down, therefore your monthly payment comes down.
Well, that's mega.
Yeah.
So obviously, when we've just spoken about the person who's saving, and we'll bring it right back to saving, I hope a lot of people did take a lot from that in regards to inflation. When somebody is saving, obviously they're saving monthly to then outpace inflation, so then they know that they're going to be in a profit, let's say in decades' time instead of tomorrow's time, and they've not got that instant gratification of seeing that the money's still in the bank account and they don't feel like they're losing money. What is the best way to describe compound investing for the person who's listening? I don't have to word the question in a way of compound
interest. eighth wonder of the world, is it? Albert Einstein said. So basically, it's growth on growth.
Yeah.
That's the easiest way to explain it.
Yeah, because I think a lot of people can think, right, I'm saving, but I'm just putting, let's say they were just putting £100 a month away.
Yeah.
But it's just £100 a month that I'm putting away, and I might be earning a little bit on it, but where does the compound interest then come into that?
So from a word explanation, it's growth on growth. From a picturing something in your head explanation is, imagine you're at the top of a mountain and you get this little snowball and you roll it down that mountain. And that snowball just gets bigger and bigger and bigger and bigger over time, okay? Because as that snow is picking up more snow, as rolling, it's picking up more snow and it's getting bigger and bigger, and it's sort of to the point where the only thing that's going to stop it is if you stand in its way, or the mountain runs out, the timeline runs out. So if you're investing and you're putting into the market and you're seeing these small returns, it's very hard to get disheartened. It's very easy to get disheartened, and you go, oh God, it's not very sexy, this, it's not really doing much, blah, blah, blah. But you think of it like this. If you're smashing it and you've got 100 grand invested, right, and I've only got £1,000 invested, and we're both invested in the exact same portfolio over the same 12-month period, and we get, for the argument's sake, 10%, yeah? Because we're investing in the exact same thing, we've got the same returns. I make £100, right? You make 10 grand, okay? Because the growth, there's no change in the growth amount. We've both got 10%. The numerical difference is the fact that you've got a bigger pot than I've got.
Yeah.
Right? So, although we got the same rate of return, you've made, what's that, 10 times, 100 times the return. And then you've made 100 times the return I've made.
And then the next year, obviously.
And then the next year, you go again and go again and go again.
Yeah.
So it starts off small, right? And you've just got to be able to accept that. Like, when you're starting off and you're paying regularly, you're not going to see huge benefits. But for clients that have been investing for 30, 40 years, most of their portfolio value has come from those early years because it's had the longest to grow and compound. Yeah. So going back to that analogy, what I said, you can have 100 grand, I can have 1,000, we get the same returns. You get 100 times the returns than I get, but we've both got the same amount of growth. So it's about time in the market. It's it's not about timing the market, trying to time ups and downs in market volatility. It's just about putting your money to work and just leaving it, because the more time it is in the market, the bigger that snowball is going to get. Yeah, and you're just going to get growth on growth on growth on growth. So just one final point in the compound, if you get £100 return year one, you're going to get £110 return year two, because you're going to get 10% on the growth.
And that was if you didn't add anything else in.
Yeah, exactly. And that's the power and the beauty of investing.
Yeah.
Because once it gets to a certain point, there's nothing stopping that snowball.
And that's almost earning money itself.
Yeah, exactly. So I have clients at the back end of their sort of investing life where their portfolios they're just taking care of themselves.
Yeah.
Where they're providing enough growth where that client can pull that growth out, live on it, and never ever exhaust the pot. The pot never gets smaller. It just produces a growth year on year, and that client can live off that.
Yeah,
that's the position that you want to. That's the ideal position.
And that can come down to the lady or the couple that wanted to retire at 40. If they've built up that pot, it's like, right, we can live on this now until the pension comes in.
Yeah, exactly. Yeah, absolutely. And that's the ideal pot. And really, what you want to be doing is building enough wealth where it takes care of itself, it takes care of you, and then you can pass that wealth on intergenerationally down the family and make some intergenerational wealth building.
Yeah, amazing. Because obviously that comes from, when we're talking about investing, that's a portfolio, like you mentioned, of assets. I think a lot of people can think that they've just got to have money in one set savings account. It's like you said, is it good to have a good spread of where you're keeping money? Yeah,
so I mean, I don't advise clients having anything over and above that emergency fund. So you can have an emergency fund, just a bank account. I would always say put it in an ISA, a cash ISA, because the small amount of growth you're going to get is tax-free, because we live in the UK and we get taxed out our eyeballs. So even interest on savings is taxed.
If it's in the bank.
If it's in the bank. If it's not in an ISA, right? There's allowances and all that, but you can find yourself, especially with rates where they are at the minute, you don't need that much that's outside of it, what we call an unwrapped environment, a non-tax-free environment, where you could potentially pay tax on it. So set up a savings account, an ISA, set up a cash ISA, get yourself to 3 to 6 months. Outside of that, you could just get a stocks and shares ISA, and you could make sure that you're diversified. There's different asset classes that you can invest in, which I'm sure you'll want me to elaborate on. So I'll do that. But there's different risk elements with that, and you've got to basically, what I help clients do is I help them understand what their attitude to risk is, and then put together a bespoke offering that is aligned to that attitude to risk. Because there's no point you coming to me and saying, right, Jack, I'm super conservative, and I just say, no, never mind that. We're just going to put you in a medium to upper medium risk profile investment that's not defensive and not conservative, and it's not appropriate for you at all. Pointless advice. It has to be tailored to you.
Yeah.
So when you're thinking about where you put your money or what assets you put your money into, you've got your 3 main asset classes, and there's others as well, alternatives, but the 3 main ones that you want to be thinking about, you've got stocks and shares. They're the same thing. There's loads of jargon in finance. You've got stocks and shares, equities, it's all the same stuff. I don't even know why it's called stocks and shares. It's just a share. Okay. So a simple analogy of that is, you like Amazon, so you buy some shares in Amazon. You now technically you are an owner of Amazon. So as Amazon thrives and it does well and it creates a profit, you will receive a portion of those profits, okay, in the form of a dividend payment or a return, yeah? So you're making money now because you own a share of a company that's performing well, and you're getting a piece of those profits. As Amazon continues to grow and it expands, the value of the company also goes up. So therefore, the share you own also increases in value because someone is now willing to pay more than what you paid for it. So that's also a way to help you grow your wealth. So they're the pros of shares. The cons of shares are they're very prone to what happens in the world. They're very volatile in the short term. So shares will go up and down in the short term. So an example of that is a year or so ago, don't quote me on this, China turned around and said, we're not building the latest iPhone in our factories. I think that day, Apple dropped 5%. Now, when you're the size of Apple, 5% is billions of dollars worth of value gone. So that's a kind of scenario where shares can be affected by what happens in the world. Same as when conflicts happen and things like that, share prices go up.
I imagine like when COVID happened as well.
Yeah, exactly. So when COVID happened, I think it was like a 34% global drop-off. It's like one of the fastest falls in market history.
Yeah.
You know, it was an unprecedented period. These things happen, right? So you've got to be comfortable with the fact that the value of what you own is going to go up and down in the short term and be okay with that.
Yeah.
So pros and cons. Then you have bonds. So you may have heard of bonds before. Bonds in my world are slightly different to maybe what people may have heard of a bond. A bond is basically, the jargon term is a fixed interest security. So in a simple term, it's effectively a loan. So you're a business owner, you want to scale, but you don't want to hand over any ownership. You don't want to sell any shares of your business because you want to retain ownership. What you do is you'd issue a bond. So I'll lend you some money. You'll take that money and you'll invest it in your business and grow. And what you'll do is you'll promise to pay me that money back with a fixed amount of interest, a small amount of interest. These are what we call defensive assets. They're less volatile, they're much more lower risk, but they're also a lower return. So again, there's a relationship between risk and reward. The more volatile, riskier elements of investments often return better returns. The more safer elements give you a much more steady return. Okay, and then you've got property. And in my world, it's more commercial property. So think like retail parks, office buildings, Amazon distribution warehouses, things like that. They're a great investment for the long term because you can invest in them. You own a piece of that building effectively. That building generates a rental income. You receive a portion of that rental income to help grow your overall net worth. As the building increases in value, your portion of what you're invested in increases, or your unit in that building increases. And then the con to that, unfortunately, is what we call an illiquid asset. So when we talked about risk before, there's different risks in investing. Liquidity risk is basically the risk you run when you put your money into an investment and it's hard to pull that money back out. Because if you wanted to pull your money out of a commercial property, you can't just sell a building overnight. Yeah, it takes 6 months, potentially more, right? So again, you have to understand that that money is tied up in that piece of real estate for 5, 10, 15 years, and you know that it's going to go up in value over time, it's going to generate an income. So you've got to spread your risks around. Property, again, very low risk, low return. You don't see periods of volatility, but there is that liquidity risk. Yeah. So what I then do with someone is I say, right, where do you fall? What is your attitude to risk? What's your comfort level? Okay, let's get a piece of each of those asset classes and put them into a portfolio with different, think of a pie, different slice sizes of each of those assets that's aligned to your attitude to risk. It's going to get you what you want to get. Yeah. It's going to get you growth, return, etc.
And it obviously goes back to the mindset of not putting all your eggs in one basket.
Yeah, absolutely.
Having a good even spread.
Diversification is key. Now, you can still be diversified and be in one asset class.
Yeah.
So, for someone like you that's young, that's investing, you really should all be entirely in shares because you've got the long time horizon. The bigger your time horizon, so your timeline between when you're investing and when you actually need that money, the better opportunity for growth you have, and the better ability you have to sustain those short-term drops in value. So like when COVID happened, if you were an investor, it doesn't matter because COVID's already been and gone. Markets are already above and beyond what they were pre-pandemic, and you've got 20 or 30 years left.
I think that's even just a good example for people who are worried about investing, like COVID's literally just happened.
Well, when COVID happened, we were advising clients, if you've got any capital on deposit, put it in the market now.
Yeah.
Because when the market recovers, you're 30% up immediately. And we had clients that did that. We had one particular client that put £1 million in just at the bottom. And obviously they love us now. They think the world of us because of that growth.
Yeah.
But a lot of clients were on the phone going, "Oh my God, what's happening? This is unprecedented." And going back to what I said, our job is to calm people down and say, "This is what's happening. This is why it's happening. Just relax. Let's think of the bigger picture. Let's think about the long term. We're okay."
Yeah.
And that's why you always have an emergency fund as well.
Well, one of the things that I've taken just from listening to what you've been saying about like stuff with clients and the way people should invest is it's very emotionally driven, and it does link down to things like discipline and resilience and just common terms and mentalities that people may think are related towards fitness or being athletic or striving towards being successful. But when it comes to your finance as well, I'm guessing it's the exact same thing. If something happens and there's a big massive drop in the market, that could be the exact same as if you just had an injury and you're an athlete. It's like, right, how can we work around this?
Yeah, completely. So I don't think we've not touched on that, have we? But my relationship to clients is an ongoing relationship. So once a client is my client, it's ongoing then, because life is very dynamic. Things change in your circumstances all the time. Jobs, businesses, not just like legislation in the UK changes every 5 minutes. So a loophole that we were using last year, we may not be able to use this year. So again, I'm always keeping clients up to date with that and ongoing advice. And that's why the regular reviews and ongoing advice is so important, because what happens with clients, for people that are watching, is this is the plan, this is the timeline, and over time they just go like that. So my job is to bring them back on track. Right, you said you wanted to achieve this, let's carry on, let's keep on doing what we need to do. Don't make decisions. I have difficult conversations. I've had meetings with clients that, the first annual review meeting, all their investments are down in value. Think how hard that is as a conversation to have with someone, to sit with someone and say, look, and the client blames you. You said that this was going to happen. You said that my investments were going to go. Well, yeah, I know, but I didn't know that, Israel was going to kick off, or Russia was going to invade Ukraine, or a pandemic was going to happen. Things happen outside of our control. We can only control the variables that are, aligned to us, and so, but the outside factors we can't. We just have to improvise, adapt, and overcome to those situations. Yeah,
I think it's about being a lot more logical instead of emotional.
Yeah, absolutely. Those words are perfect, and I say, look, let's think about this logically, not emotionally. Things will happen. There will 100% be times, if you're an investor and you're building your wealth, where you log into your investments and they're down in value. 100%, right? You've got to be able to get over that emotionally. And if you're not ready for that, you're not ready to start investing. Okay, but the problem is you'll never make a move and you'll never get to where you want to be. So you just have to accept that there are periods where things aren't going the way you want them to go. But again, it's about taking a step back and zooming out and looking at the bigger picture. Because I could pull any chart up of any market or asset class and go, look, if you'd have put your money in 20 years ago, this is where you'd be now. Never mind. So if you put your money in here, you get your money out up here. All this in between doesn't matter. The ups and downs and everything, it doesn't matter. As long as your overall capital value is increased over time at a rate that you're comfortable with an exposure of risk that you're comfortable with, all the noise in between doesn't matter.
So for the person who's just started investing, who's having those mornings where they wake up and they're seeing that there's a drop in the market and their money's going down, is that the best piece of advice you'd probably give, is just be a little bit more
just ignore
logical?
it. I mean, you're a client. People probably, I don't know if they know that, but when we set your app up, I said, don't check it every day.
Yeah.
Because you can drive yourself insane. You can check it. Oh my God, it's down.
Yeah.
I'll check it. Why is it down? What's going on?
I think that's so crazy, because that relates so much to everything in life. Whereas obviously we're in a time now where social media's driving most people's businesses. Some people can post a reel on Instagram, a TikTok or a YouTube video, and the views start going up, and then they stop and they're like, right, I'm an absolute piece of shit, I'm worthless. My content's rubbish.
Same. Oh, it's like I work with a lot of online coaches, right? And you guys are it's really easy for me to explain the concept and principles of investing to you guys. You just get it because I just relate it to scales for one of your clients. You know, when you start coaching a client, it's not just a straight line, straight down from starting weight to end weight.
Yeah.
There's fluctuations all over the place. So if you invert that chart, that's the investment chart. Investments don't grow in a straight line. So you start here, you finish up here. There's going to be ups and downs
Zigzags
in between.
on the way up.
So it's exactly the same. So I love working with coaches because they just get it straight away. They get that concept. But trying to sort of explain that to the general populace is sometimes a little bit difficult. So you just got to position it correctly. But it's just a part of investing. Now, we're going a lot into investing, but like the financial planning and building wealth, it's not just about investing. It's a holistic approach. It's, you know, are you earning enough? You know, do you need to be able to earn more? Is the business performing more? Are you budgeting correctly? Is your behavior right? Is your relationship with money good? You know, are you diversified? Are you protected? Is the financial... There's loads of stuff that we cover off. Investing is just one piece of the puzzle to building that overall wealth. But it's...
And something you just touched on, which we will dive into really quickly. How would somebody know they've got a bad relationship with money?
I mean, I guess the easiest thing is they're constantly waiting for payday and they've got nothing behind them, you know, and we see this. Do
you think a lot of people are experiencing that but ignoring it?
Yeah, massively. 100%. The amount of people that just stick their head in the sand and just ignore
that something's probably not moving in the right direction.
Yeah.
Because arguably you should have at least some savings. I understand that, you know, cost of living and how expensive things can be. But if you're in a situation where you can budget and you have got money coming in, surely there's got to be somewhere where you can still find some way to save.
Yeah, because a lot of it's down to decisions, isn't it? You know, did you need to go and finance that car? No. You know, and we've got to be careful here how we speak, because I understand there's a lot of people currently in the UK that are struggling financially because of everything that's going on. But we're talking about business owners here, aren't we? We're talking about people that are at a level of success, right? A prime example is I've had a client that's income's doing really well, but never seems to have any money, right? So we put these plans in place, and it's always a struggle. I don't know if I can commit to that. I'm like, you're earning, you know, a good chunk of money a month. So how are you not able to commit to that? And as someone in that position, they could earn 10 grand a month, right? And still never have any money at the end of the month because the relationship with money is poor, right? So it's about just taking a step back and going, right, where is all my money going? And you can do that really easy. You know, it doesn't take 10 minutes to sit down and look at your banking app, fly through your expenses, and you'll very quickly start to see where all your money's going. Yeah, you tighten that belt, all of a sudden you've got some disposable income, and then you can go, oh, actually, I can build this emergency fund. You box that off in 6 months. All right, well, now I've got that. What's the next step? Now I can start investing. And it becomes a better relationship. And then what I find with a lot of people, and with me myself, it almost becomes a game then. Like, how much can I get to? What level can I get to? How much can I invest, etc. You get to that goal, and then you just set another goal, and you keep on going. And
so would you say that investing, saving is a non-negotiable?
Absolutely.
Yeah.
100%. 100%. Especially if you're a business owner, because you don't know what's coming around the corner.
Yeah.
Right? So full of little scenarios here. I've got one scenario of two young guys absolutely smashing it. They've thrown themselves into a business. They've ended up pulling it off. They're doing about 20 grand a week.
Wow.
Okay, obscene amount of money. They were doing the bare minimum with investments. And I had to sit them both down, young lads, and just say, look, I wouldn't be able to live myself as your advisor as a duty of care I've got if we didn't put some proper planning and commit some of this money into your investments and your financial planning. Because what if this lasts for 12 months and it all falls apart and it's all for nothing? Do you know what I mean? You've done 20 grand a week and you've got nothing to show for it. So it is an absolute non-negotiable because you don't know what's around the corner.
That's a good way to frame it as well, is you need something to show for the work that you're putting
100%.
in. Having the car and the drive.
There's nothing wrong with the car and the drive. There's nothing wrong with the watch. There's nothing wrong with this and that. But you will sleep much better at night knowing that you hit XYZ target before you pull the trigger on those materialistic items, knowing that you've got your wealth growing for you and you're contributing to your wealth. Because what if something happens and you've worked your ass off and you didn't make your money work in turn for you in return? Do you know what I mean?
Yeah, and I think a lot of people can struggle to understand that, and they kind of think it is a scam when people say your money needs to work for you, but you just give plenty of examples when we've gone through this podcast at the ways that it can.
Mate, you've only got to look at the richest people in the world, right? They all have a team of guys like me, probably better than me, to be honest. I'll take that back actually. But you'll have they'll all have a team of guys like me around them all the time, giving them advice, helping them plan, making sure that they're investing, making sure it's tax efficient, making sure it's structured in the right way, making sure their wealth is protected. So you can go, oh, it's a scam, or you can go, well, all the wealthy people are investing, right? And I'm what I would call as, I'm poor at the moment and I'm not investing. So it can't be that much of a scam. Do you know what I mean? Once you've got over that mindset, the issue is that we have is there's zero education. There's nothing's taught in school, none of that. So it's very hard to seek advice. But I really try and push on anyone that's a business owner or self-employed. You use an accountant. Yeah. Why do you use accounting? Because you can't be asked to try and do your own accounts. You don't even know where to start, and you dread the idea of trying to learn because there's so much that you don't know. So you just pay an accountant. You should also have a financial advisor. The two go hand in hand, because he's going to help you stop, or he or she's going to help you stop paying tax, but your advisor is going to help you then take that money and put it to work and start building your money for you. Because if you're yourself, you're self-employed, you work your tits off. You work so hard, so you want something to show for it, and you want to know that money that you're grinding for is working for you. It's not just sitting in the bank, not being spent on materialistic stuff, not losing value in the bank, but it's actually working for you, it's growing.
Yeah. And do you think a lot of people, I know you said that it can come down to a lack of education, and you can find this with coaching, where their ego won't let them come to somebody else and be like, I need advice.
Sometimes, yeah. I had an interesting comment, and I've had it before this, where someone said, we were talking about pensions and investing for the long term and stuff, and he's doing really well, and they said, I'm not going to need a pension. Now, I get where he's coming from, because he's, in his mind, he's going, I'm going to be so successful, I'm not going to need one. Well, what's the point in earning all that money if you're not going to put it somewhere, if you're not going to facilitate it somewhere? And I had to challenge them on it, and I said, well, I'm going to say, you do need a pension, because, just to rattle off a couple of benefits, pension grows entirely free of any income or capital gains tax. As a company owner, all the contributions you pay into a pension are wiped off your company earnings and save you on corporation tax. So it's a tax mitigation tool. On top of that, a pension falls outside of the estate, so it doesn't fall into the sort of remit of inheritance tax. So you can build wealth outside of the estate. You can also pass it on. So it's really good for like an intergenerational tool. So you can pass that wealth on through the family. And on top of that as well, if it's structured in the right way, you can buy commercial property with a pension and get all the tax benefits on that side of things. So I had to sort of challenge him on it and remind that client that actually you do need a pension, because if you're going to be really successful, where are you going to put this money? What's the point in just stacking it in the bank? It's not going to do anything for you. Whereas you've listed all the things that are important to me, passing your wealth on, making sure that people that you leave behind are looked after, potentially buying a unit, all these things. I've had to just remind them of that. And then they go, oh yeah, actually fair one. Yeah, I probably do need a pension. Yeah. Do you know what I mean? So it can be too easy to lose sight of why you're doing what you're doing. That's where I'm here to say, well, actually, we're doing it because of this. Remember, this is what you told me you wanted to achieve, and we're going to get there.
Yeah. 100%, and I think that can come down to mindset as well, because obviously the guy's wanting to strive and be really, really successful, but you also need somebody in your corner who's going to be like, no, this is probably the best decision to make. And
It's accountability. That's why people pay coaches. Why I've had a coach, because I need someone just to tell me what to do and keep me up the arse on a weekly basis.
Yeah.
I mean, I don't do that's not really my role, but what my role is to say, look, this is what we set out to do.
Yeah.
So let's stick to it.
Yeah.
Yeah. That's another big value add, because I can guarantee we'll sit down in 5 years with that client and go, look how much progress you've made.
Yeah.
And if we didn't do that, you wouldn't be there.
Amazing, mate. Well, that will wrap up this episode, and it's been an absolute pleasure. I'm sure I will have you on in the future. But for anybody who's looking to get in contact with yourself or speak to yourself about the sort of things that you've spoken about today, where would they go and look?
So I've got an Instagram handle called JG Wealth Management. That's effectively my sort of platform that I operate on. I get a lot of clients online that reach out to me through there and introduce themselves through there. So you can drop me a message, and I'm always open to have a conversation with the right client, a qualifying client. So yeah, you can find me on there. Yeah, amazing. If anyone's got any questions that they want to ask me about Jack, you can message me and I'll send them over your way. But yeah, I appreciate everyone who's listened to this episode, and I hope you can take a lot from it. If you're not already, please subscribe on YouTube. If you're watching it right now, just zoom out, click the subscribe button. You'll do me a massive favour. Like the video as well. And if you're listening on Spotify, just click the follow button, because it does us the world of good. And we'll catch you in the next one.